In today's video, I'm going to walk you through 4 critical pension factors that can dramatically impact your retirement security. Factors that many financial advisors either overlook or do not fully explain. Over the years, I've reviewed a lot of pension plans with clients and prospects across many different industries and income levels. And what I've discovered is that your pension decisions, how you take it, when you take it, and how you coordinate it with the rest of your financial life can literally add hundreds of thousands of dollars to your retirement income or leave you exposed to risks you may not even realize are there. So if you have a pension or are expected to receive one, this video could be one of the most valuable planning tools you watch all year. Let's jump right into it and start with the first thing you need to understand, and that's your payout options. This is not going to be an exhaustive list, but I am going to give you real examples of when each option might make sense and how to think about them. I'm also going to use some numbers from a pension statement I recently reviewed for someone in their early 60s. The exact numbers are not what's important here. What matters is understanding the relationship between the different payout options. The first option is to take the full lump sum. In our example, let's say the lump sum is $400,000 as a one-time payment. That goes into an IRA. This gives you total control. You can invest it, spend it, or leave it to your heirs. People might choose this option if they are confident investors, have a shorter life expectancy, or want more legacy flexibility. But you need to be careful. With the lump sum option, you take all the risk. You could outlive your money, or you can make poor investment decisions that reduce your retirement security. For some high net worth clients who are never going to outlive their money, this can be a great option because they can roll that money into something they control. But if you're on a razor-thin retirement plan, I would typically lean toward keeping the pension. The next option is the 10-year certain option. In this example, it offers $4,200 a month for 10 years, and then it stops. This is the highest monthly income option, but it only lasts for 1 decade. If you die before, your beneficiaries receive the rest of the 10 years. It may be suited for someone with health concerns or someone who has other guaranteed income sources kicking in later, like delayed Social Security or other annuities. But the downside is obvious. If you live longer than 10 years, the income stops entirely. Also, if you add up all the payments over the next decade, you get $504,000. That is only $104,000 more than taking the lump sum. So if you're considering this option, you should run a present value calculation and compare it to the lump sum option. In this example, for the 10-year certain option to make sense, you would need to average less than 4.4% on the lump sum payout. So if you believe you can earn more than 4.4%, the 10-year certain option payout might be a better option if you're comparing those two alone. A variation of that is the 10-year certain and life option. In this example, it pays $2,300 per month for life, with a guarantee that if you die within the first 10 years, your beneficiaries receive the remaining payments. This can be a nice balance between securing long-time income and protecting your family early on. However, the monthly benefit is lower than the straight 10-year certain option because it also gives you that lifetime coverage. Then there's the 100% joint and survivor option. This pays $2,100 per month in our example for your lifetime, and then continues that same amount for your spouse after you pass away. This is a popular choice for married couples who rely heavily on that pension income. It offers a peace of mind, but it also comes with the lowest monthly payout because the pension is potentially covering 2 lives instead of 1. If you're looking for middle ground here, there is the 50% joint and survivor option. In this example, it pays $2,300 per month while you are alive, and after you pass away, your spouse continues payments of $1,150 per month. This gives you some survivor protection while still providing income today. But you need to make sure your spouse would be financially prepared for the reduced income after your death. Because remember, if you are both receiving Social Security, they are going to lose one of the Social Security benefits also. Lastly, there is the single life annuity. This pays $2,500 per month as long as you live, but nothing continues after you're gone. This can work well for someone who is single or whose spouse does not need the income. It pays more per month than the joint options, but it does come with no legacy or survivor benefit. So how do you choose? You need to consider your health, your spouse's needs, if you're married, your comfort level managing investments, and whether you want to prioritize lifetime income, legacy, or flexibility. And remember, these decisions are usually permanent. That's why I always recommend working through a full analysis before locking in your choice. And another payout option that does not always get talked about is something called a level income option, or sometimes a Social Security bridge option. This is usually designed for someone retiring before Social Security even begins. With this option, the pension pays you more income in the earlier years in retirement, and then the payout drops later when Social Security is expected to start. The goal is smooth out your total retirement income. So instead of getting the same pension every month for life, you may get a higher pension before Social Security starts and then a lower pension after Social Security begins. This can be helpful if you are retiring early and need to bridge the gap before Social Security. But not all plans have this, so take a look at yours. And it is also important to read all the definitions as you're reviewing all of these options. The second thing to know is how your pension is taxed, and this can vary significantly by state. One of the most overlooked parts of pension planning is state taxes. And here's the reality: not all states treat pension income the same. In fact, where you live in retirement could make thousands of dollars of difference every single year. If you live in a state with no income tax, like Florida, Texas, Nevada, or Tennessee, you generally do not need to worry about state income taxes on your pension. That can be a huge advantage, and it is one of the reasons these states are so popular with retirees. But even in states that do have income tax, there are often important carve-outs and benefits. Take New York, for example, which is my home state. While New York does have a state income tax, many government workers, especially those with New York state or local pensions, may have their entire pension income exempt from state taxes. Other states like Colorado, Georgia, or Virginia may allow retirees to exclude partial amounts of pension or retirement income each year. So coordinating taxes and income thresholds can become an important part of the plan if you live in one of these states. The point is this: your pension may go a lot further depending on where you live. So if you're planning to move in retirement, or you simply want to understand what your net income will actually look like, it is worth checking your state's pension and retirement tax rules. You also want to know whether you qualify for any age-based or government employee-based exclusions. And if you've found this content useful so far, please like and subscribe to the channel and let me know what you'd like to see covered next. The third thing to know is that your pension takes on investment risk and longevity risk, not you. The pension fund is responsible for growing the assets, making the investment decisions, and ensuring it can pay benefits for the rest of your life. That is a massive contrast to a 401k or a lump sum rollover where you carry the full weight of market performance, timing, and withdrawal decisions. Even better, if you choose a lifetime income option, your income is guaranteed for life. If you live to 100, the pension keeps paying. That is what we mean when we say the pension takes on longevity risk. You do not have to worry about outliving that income stream. And even in the rare case where a pension plan fails, many pensions are insured by the Pension Benefit Guaranty Corporation, also known as the PBGC. As of 2026, the PBGC guarantees up to $7,789 per month for someone age 65 under a single life annuity structure. For retirees who value security and predictability, that can be a very strong reason to keep the pension rather than rolling it over or taking a lump sum. Now, here's the trade-off, which brings us to point 4. Most U.S. pensions do not include a cost of living adjustment, also known as COLA. That means your $2,500 per month today is still $2,500 a month 10, 15, and 20 years from now, even though groceries, healthcare, property taxes, insurance, and everyday living expenses will likely be much higher. According to the Bureau of Labor Statistics, inflation reduces the purchasing power of a dollar, and at a steady 3% annual inflation rate, purchasing power would fall by roughly half over 24 years. So if you're retiring in your 60s and expect to live well into your 80s or beyond, a flat pension can quietly lose its ability to support your lifestyle. And if we have a few big inflation spikes like we've seen in recent years, it can become a real problem. A few government plans and some union-based pensions do offer COLAs, but those are not very common. If you have one, you're fortunate. But many retirees, especially in the private sector, do not get that built-in inflation protection. This is one of the reasons some people consider rolling over a pension into annuity, specifically one that includes rising income features or COLA riders. It's also why some people choose to roll over their pensions, put half into an annuity and the other half into the markets. It can be a little bit of a hedge. Some annuities allow your income to increase over time, either by a fixed percentage like 3% a year or based on an investment index. The trade-off is that these annuities usually start with a lower monthly payout than a level annuity or pension, but they can grow over time and help preserve purchasing power. So when you put these two facts together, the planning becomes really important. Pensions offer guaranteed income and can take investment and longevity risk off of your plate, but many pensions do not protect you from inflation. So for some retirees, it may make sense to consider an annuity that adds back in some of that missing inflation protection. That said, annuities also have their downside. They can come with costs, and not all annuities are created equal. Many include complex riders and fees, and some reduce flexibility. And once you purchase one, you may not be able to change your mind without very large fees. But for the right retiree, particularly someone worried about inflation and a long retirement, an annuity can be a smart supplement or an alternative to a flat pension. Ultimately, it does come down to the risks that matter most to you. Is it market risk or is it inflation erosion? A pension often shields you from one. And getting that balance right is one of the most important retirement planning decisions you'll make. So here's the big takeaway. A pension can give you a strong foundation for retirement, but the option you choose can affect your income, your taxes, and your spouse for the rest of your life. If you want help reviewing your pension and how it fits with Social Security and your investments and your retirement goals, click on that link below to schedule a free meeting with me. We'll help you understand your options and build a plan that is right for you. I'll see you in the next video.